Good morning and welcome to SIPA. I think most of you know me, but I'm Jacob Lew. I'm a faculty policy director here at the Institute of Global Politics at SIPA and a member of the faculty. And I thank you for joining us for what I know is going to be a timely and very interesting substantive conversation. One of IGP's core missions is to serve as a forum for challenging ideas that can be debated seriously, where scholars and policymakers engage one another thoughtfully, rigorously, and with mutual respect, even when there are disagreements. At a moment when economic policy debates have become increasingly polarized, we believe it's more important than ever to create a space for open exchange grounded in evidence and expertise, rather than slogans or sound bites. And today's discussion reflects that commitment. We're honored to be joined this morning by Stephen Miran, a member of the Federal Reserve Board of Governors, and until recently, chair of the Council of Economic Advisors for President Trump. Governor Miran brings to this conversation a background that spans academia, government service, and the financial sector. He was trained as an economist at Boston University and Harvard, and his early research focused on household saving behavior and fiscal policy, work shaped in part by his mentorship under Martin Feldstein, who on a personal note was always generous to me in offering wise counsel and advice. Governor Miran's career has also bridged public policy and private markets, from portfolio management roles in the investment world to senior economic advisory positions during the COVID-19 crisis at the Treasury Department, where he contributed to the development of the CARES Act. More recently, his writing and policy work have placed him at the center of debates over trade, tariffs, fiscal policy, and the dollar's role in the global financial system. Arguments that have sparked strong reactions across a wide range of views. At IGP, we welcome that kind of engagement, not because we expect consensus and not because we think there's a way to resolve issues like inflation in an hour, but because grappling seriously with difficult ideas sharpens analysis and improves policy making and policy outcomes. We're equally fortunate to have my colleague and friend Richard Clarida moderating today's discussion. I've known Rich since I was at Treasury, and he has always been generous in sharing wise counsel with, and I've collaborated with him often since joining Columbia almost 10 years ago. He's the C. Lowell Harris Professor of Economics, a Professor of International and Public Affairs, and an IGP Faculty Advisory Board member. His experience as a former vice chair of the Federal Reserve, appointed in the first Trump administration, and assistant secretary of the Treasury under President George W. Bush, makes him uniquely well-suited to guide today's conversation. And without further ado, Governor Miran, please come up and welcome me in joining Governor Miran to the stage.
Welcome to the stage, Federal Reserve Governor Stephen Miran.
Thank you, Mr. Secretary, for that far too kind introduction. I appreciate the opportunity to speak here today. When I offered my assessment of monetary policy in my first speech as a Federal Reserve Governor in September, I assumed inflation for core goods and non-housing core services would continue to run at current rates. While that was a useful working assumption at the time, today I'll break down my inflation outlook in more detail. Specifically, I'll share my interpretation of inflation's components and how this influences my perception of progress toward our 2% target. Shelter costs are top of mind for households and a large component of inflation indices. But calculating shelter is far from simple. For instance, the Personal Consumption Expenditures, or PCE, price index that the Federal Reserve targets includes housing costs for all households in the economy. That seems appropriate for capturing prices associated with all consumer spending, but not ideal as a measure of current supply and demand pressures. Figure 1 makes that clear. As the economy emerged from the pandemic, demand for housing outstripped supply, and market rents for new tenants jumped. But the PCE shelter index for all households lagged, as rents only reset when people move or renew their leases. PCE will always lag market rents. As recently as last year, the PCE shelter index still had catching up to do, creating uncertainty as to how long measured inflation would remain elevated. That is no longer the case. Indeed, a separate all-tenant rent index, drawn from the same microdata as PCE shelter, has caught up to new tenant rents, while PCE shelter has actually overshot new rents. Based on this catch-up being complete, I expect a faster fall in PCE shelter inflation. The current elevated readings for shelter inflation are an after-echo of previous, rather than current, supply-demand imbalances in the economy. For the past 2 years, we've seen extremely low increases in new tenant rents. Measures by Cotality and Apartment List show that's persisted in recent quarters. I therefore expect a faster decline in PCE shelter inflation. 2 factors give me additional confidence. First, the negative population shock resulting from a reversal in net migration, and second, an elevated ratio of nominal shelter services consumption relative to overall consumption, which has historically been mean reverting. Another important part of household budgets is the cost of services besides housing, food, and energy. These services are about half of household spending and include childcare, education, entertainment, and medical expenses. Core non-housing services inflation has moved sideways this year, somewhat above the average level observed from 2002 to 2007, a useful reference period when core PCE inflation averaged 2%. However, I'm not worried about non-housing services. This is because wages are the primary driver of service inflation. Many service prices are driven by labor costs. For instance, labor compensation is about 60% of value added in leisure and hospitality and 83% in education and health services. Over the medium term, non-housing services will follow labor market pressures. Unemployment has trended higher for over 2 years and wage growth lower. Additional measures of labor market tightness, such as job openings, consumer surveys about the difficulty of finding jobs, long-term layoffs, and the duration of unemployment have all suggested a loosening labor market for several years, tilting nominal wage growth risks toward the downside. A notable aspect of core services inflation is that not all components are measured from directly observed transactions. Many services components in this index are imputed in various ways and do not capture information about supply-demand imbalances that are relevant for monetary policy. A prime example is portfolio management services, which have contributed 1/4 point to core PCE inflation in the last year, well above their long-run average. The Bureau of Economic Analysis measures portfolio management costs based on overall revenues generated by asset managers. If the stock market goes up and boosts assets under management, revenues move in tandem since they are typically a fixed percentage fee of assets. What ought to be recorded as an increased quantity of services consumed is instead recorded as an increased prices. There may, for national accounting purposes, be a good reason for doing it this way. But for monetary policy purposes, there is none, and it would be foolish of us to chase statistical quirks rather than focus on actual consumer prices. Remarkably, long-run trends in the asset management industry point towards fee compression, indicating trend deflation. Morningstar found the average expense ratio paid by investors fell nearly 6% in 2024. By contrast, PCE recorded a roughly 20% increase in portfolio management fees in this period, contributing about 30 basis points to core PCE. If PCE had instead matched industry data with a 6% decline, core PCE would have been about 40 basis points lower than officially reported. Fees have consistently fallen each year for the past 2 decades and are now less than half of what they were in 2005, as seen in Figure 2. The PCE portfolio management measure contains no signal regarding tightness in the asset management industry, let alone the economy. It contains no signal for the inflation forecast going forward. It should not be used to frame underlying inflation. Yet here we are, keeping interest rates too high because of the phantom inflation of portfolio advisory fees, when what's actually happening in that industry is deflation. For these reasons, I do not take much signal from non-market-based components. When looking at market-based services, inflation in this category has come down dramatically from its peak and moved sideways since mid-2024 at around 3%. That is about 10 basis points below its average from 2002 to 2007, which again was a period in which PCE inflation was broadly at target. Core non-housing services inflation only remains elevated compared with this period because of non-market components, which are not well measured. Turning to goods prices, they have been relatively less likely to rise than other index components since the turn of the century. That trend was abruptly disrupted in the aftermath of the pandemic. After that, core goods inflation fell into negative territory for a brief period of around 1 year. Over the past 12 months, core goods inflation has picked up. The dominant narrative explaining this pattern blames US tariff policy. I am not convinced. Consider the timing, as shown in Figure 3. In core goods PCE, it appears that the increase coincides with the imposition of tariffs during this year. However, in the Consumer Price Index, the upturn began in the middle of 2024. We don't target CPI, but it contains useful information. The evidence that tariff policy neatly coincides with the increase in core goods prices is conflicted. When thinking through the effect of tariffs on prices, we must remind ourselves the larger share of incidence or burden of any economic policy, tax, subsidy, or tariff, falls on the more inelastic or inflexible party. That's because the more elastic or flexible party can change its behavior to avoid the burden of the tax. As an importer, the US is relatively more elastic since we can substitute demand across borders or manufacture goods at home. But producers' factories are installed capital that is stuck in place and immobile, and their labor is generally immobile and not easily substitutable across tradable and non-tradable sectors. As the largest trade deficit country, there are few substitutes, if any, for American demand, but there are many substitutes for potential supply. Product-level estimates of demand and supply elasticities from Ants and Soderberry can be used to examine goods-level incidence. Figure 4 draws predicted ISO incidence lines. The 45-degree line characterizes goods which have equal supply and demand elasticities, meaning incidence is evenly split between exporter and importer. The overwhelming majority of goods lie below the 45-degree line, meaning importers bear less burden. Figure 5 shows the same data in the form of a cumulative distribution of import value based on the incidence absorbed by exporters. These elasticities imply that for about 70% of import goods value, the exporter bears at least 70% of the incidence. For about half of goods value, the exporter bears at least 80% of the incidence. What we learn from these elasticities is that the overwhelming majority of this incidence falls on exporters, not importers. Of course, there are goods for which importers bear material incidence, and that will mean relative price changes. But whether they prove relevant for aggregate prices depends on other considerations. Given the Soderberry elasticities and a split of the domestic incidence between wholesale importers and consumers, it is plausible the ultimate effect of tariffs on consumer price levels will be in the neighborhood of 0.2%. Noise. By contrast, many analyses of what tariffs would do to inflation were based on empirical studies of the US-China trade conflict before the pandemic. However, these studies suffer from bias from trade rerouting and de minimis exemptions. If a Chinese exporter can avoid bearing incidence by costly transshipment or exploitation of the de minimis loophole, the incentive to do so will be highly correlated with the incidence absorbed. In other words, goods for which China would have to absorb a greater share of the tariff cost drop from the sample, while goods for which China could push through tariff costs to importers remain in the sample, violating identification restrictions. Jackson Mejia has studied this bias in pass-through estimates and finds evidence that up to 40% of product categories exposed to tariffs are affected by transshipment, with trade volumes approaching 25% for intermediate and capital goods. The de minimis exemption poses similar identification problems, meaning the transshipment effects are lower bounds on the identification problem in this literature. Additionally, these studies are short-term in nature, and incidence analyses are usually long-term. A difference in short-run and long-run elasticities is not controversial, which I'll return to. Moreover, any claim that tariffs are a current driver of inflation must be accompanied by a clear description of the counterfactual. Several analyses use the 2 decades before the pandemic as the relevant counterfactual. I do not find these periods to be reasonable given large concurrent shocks that pollute the analysis. Attributing all excess inflation over the pre-trend to tariffs is something that could be done for many recent policies or shocks, such as an emphasis on supply chain resilience after the pandemic unrelated to tariffs. One counterfactual I think makes sense to use compares import-intensive goods versus overall core goods, as shown in Figure 6. If tariffs were a recent driver of inflation, then one would expect import-intensive core goods to see substantially more inflation. In fact, total core goods prices have risen at approximately the same rate as import-intensive core goods since the end of last year. I also compare the level of inflation in the US to that of other industrialized nations, displayed in Figure 7. If US tariff policy were a material driver of domestic inflation, then US goods inflation would visibly stick out from major trading partners. Yet US inflation is comparable to that in Canada and the UK, slightly above that in the European Union, and below that in Mexico. The US doesn't stand out in any direction. Neither of these counterfactuals suggest tariffs are the primary driver of core goods inflation. Even if one believes that tariffs are driving goods inflation, the standard practice is for central bankers to look through a transient shock, as a one-time increase in the price level differs from a persistent shift to inflation. This mirrors how value-added taxes are treated by central banks. Monetary policy achieves stable prices through balancing aggregate supply and demand. Changes in prices stemming from relative tax adjustments, incidents aside, are not indicative of supply-demand imbalances. While the burden from tariffs will ultimately be borne by the exporters, this analysis is drawn from long-term elasticities. In the short run, it may take time for threats of moving supply chains to become credible, creating a lag before exporters reduce selling prices. Although I do not yet see meaningful tariff-driven inflation, it may still materialize. But over time, short-run elasticities would converge with long-run elasticities. Not only would the increase in inflation be transitory, but likely so would the increase in the price level, meaning subsequent offsetting deflation. So if tariffs are not the likely cause of the recent rise in goods inflation, then what is? One possibility is the rise in prices is noise in a volatile series, though this is not a satisfying answer. A second possibility is that the US and other advanced foreign economies are still following post-pandemic bullwhips of gradual oscillation around a lower mean level of core goods inflation. Under that scenario, last year's core goods inflation was too low, and now it is too high. Perhaps next year it will be too low again. A third, unsavory possibility is that goods inflation is settling in at a higher level than prevailed immediately pre-pandemic. After all, there were previous regimes with stable but higher core goods inflation. Higher global goods inflation could result from a long-term trend of trade restructuring that encompasses much more than tariffs, including a reduced willingness to rely on unfettered access to exports in favor of national security and geoeconomic concerns. Attention to supply chain security and resilience, which predates this year's tariffs, may mean higher core goods inflation for a longer period, though perhaps not this high. I accept I don't know what's driving higher goods inflation currently. As former Bank of England Governor Mervyn King and economist John Kay urged in Radical Uncertainty, pretending we have more knowledge than is possible will stymie our understanding of reality. Shedding that hubris will help us reach a clearer understanding of the dynamics and make better decisions. I do see reasons to be optimistic about goods inflation. One is that the rapid deregulatory push to expand supply will, all else equal, decrease prices. Another is that work by Bloomberg Economics using AI to analyze thousands of public company earnings calls indicates price pressures in measured goods inflation will begin to decline within 2 quarters. The lack of a clear downward forecast for core goods prices might suggest keeping interest rates elevated. However, I expect more than enough disinflation from housing services to counterbalance that possibility. Core goods represents just 25% of the core PCE index. Indeed, my earlier forecasts were conditioned on core goods inflation staying at this rate for higher. The risks to my forecast are if shelter inflation picks up again, or if core goods inflation remains well above 2%. I judge those cases to be unlikely. If I'm right about shelter but wrong about tariffs, we will undershoot our inflation target. To summarize, we must be thoughtful in considering genuine underlying inflationary pressures. Excess measured inflation is unreflective of current supply-demand dynamics. Shelter inflation is indicative of a supply-demand imbalance that occurred as much as 2 to 4 years ago, not today. Given monetary policy lags, we need to make policy for 2027, not 2022. A better measure of underlying inflation would account for distortions from shelter and imputed prices. Removing imputed phantom inflation like portfolio management, market-based core inflation is running below 2.6%, as seen in Figure 8. If we further remove housing and look at market-based core ex-shelter, underlying inflation is running below 2.3%, within noise of our target. Once shelter inflation has normalized from the anomalous post-pandemic experience, ordinary market-based core may be more appropriate. But my read right now is that underlying inflation is already within noise of our target. Some might accuse me of cherry-picking a preferred measure, but my gauge of underlying inflation excludes less of the index than some other measures. It's also easy to understand and is a straightforward rationale for discarding certain slices of the index. Market-based core includes 75% of overall PCE, and market-based core ex-housing includes 60%. Core services ex-housing, which some others use, is only 51% of PCE and discards goods, which are salient for households. Moreover, James Stock and Mark Watson find that market-based prices are more tightly related to cyclical measures of the economy than poorly measured components like imputed prices. Keeping policy unnecessarily tight because of an imbalance from 2022, or because of artifacts of the statistical measurement process will lead to job losses. There was a large bout of inflation that resulted in an increase in prices after the pandemic. While American families are still rightly distraught with that experience and unhappy with affordability, prices are now once again stable, albeit at higher levels. Policy should reflect that. Fortunately, the shelter outlook appears relatively clear because market rents lead measured inflation and powerful enough to overwhelm even the possibility of sustained higher goods inflation. Underlying inflation is near and further approaching our target. On the other side of our mandate, experience suggests that labor market deterioration can occur quickly and nonlinearly and be difficult to reverse. In part because monetary policy lags several quarters, a quicker pace of easing policy, as I have advocated, would appropriately move us closer to a neutral stance. Recessions are an inevitable part of the business cycle, and at some point, we will suffer one. We should strive to ensure that that point is as far in the future and as shallow as possible by appropriately calibrating monetary policy today. Thank you.
Joining Governor Miran, please welcome 21st Vice Chair of the Federal Reserve, Professor Richard Clarida.
Okay, well, lots to talk about. Excellent speech, having worked on several of those myself. I recognize the hard work that went into it. So let's begin. I'll have just the format here. I will have some questions and discussion with the governor, and then I'll segue into questions that were pre-submitted in advance, and I may add one or two myself. So let's get let's start right off. Governor Miran, in your public statements and speeches since joining the Fed, you have made the affirmative case for rate cuts, as you did today, and lo and behold, the Fed has cut rates at each of the 3 meetings you've been a governor. Now, of course, correlation's not causation, but as a data-driven economist, what data would you need to see, Governor Miran, to recommend against rate cuts at future meetings?
Sure. So as I was describing in the speech, I see lots of disinflation coming from shelter, right? And part of the reason why I'm so confident in that is because we know that the market rents and the new tenant rent index lead measured PCE inflation by quarters to a year plus, to sometimes more than that. And so we know what the future is going to look like on that, right? And what's different about now versus a year ago is that the average tenant rent index, which is very similar with, other than some sample restrictions to the PCE shelter index, has caught up to the new tenant rent index. That gives me a lot of confidence that catch-up is done in a way that I wouldn't have been confident of a year ago at this time, a year and a half ago at this time. And so for me to think that my forecast is invalidated, I'd want to see heating up in the shelter market, in the housing market. And if I start seeing articles about people getting into bidding wars over rental apartments or rental homes or whatever, that's the type of thing that would make me think, hey, maybe there is more inflation in the shelter pipeline than I thought there was credit for.
Okay, well, I guess it depends on the real estate market. I'm still seeing some of those locally. Now, through September, and I guess that's the only data we have until the next data dump from statistical authorities, both PCE and core PCE measures of inflation, at least over a 12-month basis, are basically where they were 18 months ago. And I think your charts made that point as well. The good news, I guess, is that inflation this year has not increased as many, really most forecasters projected. But 2025 will represent the 5th consecutive year that inflation has been well above the Fed's 2% target. So what would you need to see in the data to make you worried that inflation expectations are drifting up? And would this be a reason in and of itself to pause rate cuts?
So, like I said before, I think monetary policy works through balancing supply and demand, right? That's how monetary policy works. It prevents supply from getting too far out of demand, and then you have deflation, or demand from getting too far ahead, and you have inflation. And when I look at the inflation index, like I was describing before, I don't really see a lot of supply-demand imbalance. And so the fact that measured inflation has been running at a similar level to where it was in previous years is not to me the same thing as saying inflation is running where it has been in the previous years. And when I look at underlying inflation that sort of looks at those supply-demand imbalances, to me, I don't see a great deal of reason for being concerned. I see underlying inflation as running close to our target already. Now, when I look at inflation expectations in financial markets, so I like to look at CPI swaps. And I see CPI swaps on a 1 year basis, both 1, 2, 3, and 4 years ahead. They're all around our target, right? So the fixed income markets basically have us a target as far as the eye can see. If I wind up, as I said before, if I wind up being right about shelter but wrong about tariffs and core goods inflation comes down relatively quickly, then I would expect those things to start moving to the downside. But I don't really see a lot of evidence in inflation expectations data that I look at that things are getting to a place where anybody is really concerned about that.
Yeah, and certainly I think comments by your FOMC colleagues are similar. I guess one maybe just my own experience during my time, I think I said once that when measures of market-based inflation and surveys diverge, I would put weight on surveys simply because they're maybe more representative of the economy. One thing that's really stood out in the last 12 or 24 months is the divergence between the Michigan survey of expected inflation and, say, the New York Fed and other surveys, showing a really very distinct partisan split, which, interestingly, shifted sign in November of last year. So any thoughts about that, or more generally, what we're seeing in survey measures of the economic outlook?
Yeah, I mean, it's quite possible that increased polarization has changed the reliability of inflation expectations. But I've always tended to underweight the Michigan survey just because the sample is a bit small relative to national surveys, and because the sample is, I think, a bit also underrepresentative of national surveys. So that's never really been one that I've really put a lot of weight on. And then, of course, there's a question of how predictive are these things?
Yeah.
And I don't see them sort of acting in a way that really makes me very concerned.
Okay. Many folks have noted that the Greenspan Fed in the 1990s cut rates as productivity and GDP growth increased, in particular in the mid-90s. But fewer have highlighted that between 1998 and 2000, the Greenspan Fed was raising rates pretty aggressively, all the way up to 6.5%, even though productivity growth was rapid and inflation was below 2%. Of course, Chairman Greenspan once commented on irrational exuberance in financial markets around that time. So what lessons, if any, do you take from this period for current monetary policy?
So I would say a couple things in response to that. The first I'd say is that one thing that I've dwelled a lot in my first speech as a member of the Fed board is population growth dynamics. And I really think that drives a lot of the structural supply side of the economy, including something we call R star, or the neutral rate. And that's not controversial, the idea that population growth would relate to the neutral rate. And if you look at the late 90s, it was a period in which population growth really was increasing, not as much as it increased in few years before this year, in the post-pandemic experience, but it was a non-trivial increase in the population growth rate, and then around 1999-2000, that started going into reverse, and population growth started trending down. And so it does mirror somewhat the change in interest rates in the same way that I expect us to sort of be mirroring some of the change in population growth rates now. Now, as you note, I didn't sort of quantify an effect of population growth on shelter inflation in this speech. I did talk about that a little bit in my first speech, and that just gives me more confidence in the catch-up argument. But the other thing that I would say is that not all productivity growth is the same. And one question for me in what you described is, what's the source of the productivity growth? And in the late 90s, there was all this tech innovation happening in IT. And you might think that if there's new technology, it creates lots of new investment because people are investing in it. And so then there's the question of, as we would say, is the improvement in TFP gap neutral? Does it increase the output gap, or does it decrease the output gap, or does it not affect the output gap at all? Because monetary policy, as you know, has to respond to the output gap. And I am much more sympathetic to the view that technological-driven increases in productivity, as in the late 90s, will increase investment demand and therefore not have a big effect on the output gap. I am less sympathetic to that view if that increase in productivity is driven in part by changes to the regulatory code. And my view is that what's happening on the regulatory code is actually one of the most important determinants of the supply side in the economy. And if you have a regulation that functions as an effective production cap, and then you remove that production cap, it's not clear to me that you immediately get that surge in investment in the way that you do if you have a new technology. And so I don't want to say that that peeling back regulations is pure increases in potential output as opposed to none in actual output, but I think it's more potential output than an actual output. And so I think a good portion of the TFP improvements that we're going to be experiencing this year, next year, the year after, are actually result in the output gap becoming more negative and are the type of thing that monetary policy would be more inclined to accommodate.
Interesting. Okay, so how should Fed, moving away from the real economy to financial markets, how should Fed officials think about the term premium in the Treasury yield curve when they're thinking about monetary policy? So let me define terms. What is the term? You know, but just for the audience, what is the term premium? It's essentially the higher interest rate that bond investors require to hold more long-term debt. And so if the term premium goes up, and I think there's evidence in financial markets and elsewhere that it has been going up, and in particular in response to worsening fiscal prospects, how should monetary policy think about and react to it, if at all?
So let me say a couple things. First, I think that the term premium has largely been, pretty stable this year. Sorry, it's whipped around over the course of the year, but I don't think I've sort of.
I wasn't referring to this year. I think the last several years relative to the pre-pandemic period.
Sure.
Yeah.
The last several years relative to pre-pandemic, there's absolutely been a somewhat of an increase in term premium. I would say a couple things. First, I would say what the Federal Reserve does is we target inflation and unemployment, and if you have sort of a all else equal increase in the term premium, that is, for some reason there's just an increase in interest rate yields, whatever, unaccompanied by other changing underlying economic forces, then that's a tightening of financial conditions, and my inclination would be to offset it with easier Federal Reserve policy so that the effects on inflation and unemployment canceled out. Now, of course, all else is rarely equal. And if you have an expansion in the term premium, you have to ask, well, why is the term premium expanding? Exactly. And if the term premium is expanding because of something that would increase inflation or drive unemployment rate lower because of a fiscal activity, as you described before, then in my mind, the correct appropriate is the opposite, that the monetary authority offsets that. So it depends what's driving the term premium and what is what's driving it due to inflation and unemployment, and then what is the additional change to inflation and unemployment from the term premium on top of the underlying forces. Now, the second thing that I would say is I actually am more sanguine on that than many other folks are. I do expect better GDP growth in the future as a result of a variety of factors, some of which I discussed in my first speech. And some of which I didn't, things like technological improvements also. And I also expect deficits to come in as well as a result of better economic growth, as a result of additional revenue from tariffs. Tariffs are a material source of revenue which ought to underpin the bond market. And as interest rates come down because fiscal concerns alleviate because of additional revenue and better economic growth, then interest expenses come down too. And as you're aware, interest expenses soared to become the largest non-defense discretionary expenditure in recent years. And if you get a material increase if you get a decrease in interest rates as a result, you sort of get this self-fulfilling positive cycle. So I'm actually quite a bit more sanguine on those effects than some other folks are.
Well, and just parenthetically, as Secretary Bessent reminds people in his public comments, the U.S. is really the only major advanced economy bond market in which yields have fallen this year. So far consistent with that. Last week, the Fed made a lot of news, although the rate decision itself, I think, was expected. I'm going to focus not on the rate decision, but on something that may seem like a footnote in which your eyes are tempted to glaze over, but it's potentially important, and these are the so-called reserve management purchases that the Fed has, I guess, commenced, in which the Fed will be buying T-bills, I think, at a clip of $40 billion a month. So a two-part question, Governor Miran. First, talk us through the rationale for that decision, explain what reserve management purchases are and why you're doing them. And then thirdly, and the one that is all over the blogosphere, if we still have that, is this a new quantitative easing program?
So we did just start reserve management purchases about 2 weeks after we stopped QT. And what reserve management purchases do is the Federal Reserve will buy additional securities for the sake of creating new reserves in the banking system. Now, the demand for reserves is a function of a number of things. It's a function of the regulatory environment that we force banks to hold a certain number of reserves, and if the banking system, to satisfy regulations, and if the banking system grows in aggregate, or GDP grows in aggregate, or whatever happens that sort of causes the overall system to grow, then the demand for reserves will increase as well, because the demand for reserves is set as some sort of ratio pegged to other things that the bank is doing. There's also currency, right? As an economy expands, there will be increased demand for currency, and that increased demand for currency is related to the demand for reserves as well. And there are various other things that drive up the natural demand for reserves in the economy. So reserves will grow over time. That has always been the case, and that will always be the case. And the central bank has to accommodate that increased demand for reserves by creating additional reserves. How do we create additional reserves to supply reserves into that demand? We buy securities. So we go out and we do something like buy Treasury bills, as we're doing now. Now, I think that there's been, you're right, I have seen there being a lot of conversation about have we restarted QE. And the people who think that, I think, generally argue that it's because they're focused on the money supply, and we're expanding the money supply by increasing the level of reserves in the system. I'm not really convinced by that, in part because the effect of monetarist aggregates has been money aggregates has been variable over time. Yeah. And I think that with the modern, sort of corridor system and us sort of setting interest in reserves, I think that the linkage between those things has actually grown somewhat smaller. Instead, I'm focused on the net provision of risk into the financial markets, because investors have investors have a limited appetite for risk. They don't have an infinite appetite for risk. And if you increase the amount of risk that you ask investors to absorb, it will decrease the price of that risk. And that's true for any type of risk in the world. And so if the Fed does QE and it creates reserves by going out and buying long duration Treasury bonds, we've taken interest rate risk out of the investors' hands. Investors hold less interest rate risk. And so as a result, there's less risk in the system. They have greater tolerance to absorb additional types of risk. That pushes all asset prices up. And that's, in my mind, how QE often works. Yeah. And the same would be true of credit risk if we were doing the same in mortgages, and interest rate risk there too. Now, what we're doing now is not creating reserves by going out and buying longer dated bonds or mortgages. We're creating reserves by buying Treasury bills. And Treasury bills are very similar to reserves in that they're very short dated obligations with very little duration risk. Reserves are overnight money, and Treasury bills are, pretty short-term government paper. So all we've done in this case is swap one type of short-term obligation with another short-term type of obligation. The actual change in duration risk that's owned by the public hasn't really moved that much. And so it does not have the same economic or financial market consequences that a real round of quantitative easing would have. And let me make one more point on this subject, which is that when we ended QT, when we ended the runoff of the Fed's balance sheet in December 1, we didn't decide that we would replace all maturing securities with equivalent types of securities. Instead, we're still allowing mortgages to roll off our balance sheet at the same rate that they were previously, but we're replacing those mortgages with Treasury bills. So in this case, the overall level of the balance sheet doesn't change. A mortgage rolls off, we replace it with a Treasury bill. The number of reserves in the system doesn't change. This is separate from the reserve management purchases. Yeah. The number of reserves in the system doesn't change, but the amount of risk owned by the public still did change. Because before, there was this amount of duration and credit risk owned by the Fed. And now, when that mortgage rolls off because the person is moving homes, they prepay their mortgage, they move homes, whatever, the recreated MBS has to be absorbed by the public. And so that interest rate risk is still being injected into the public. And so the tightening effects of QT are still with us, even after we ended balance sheet runoff, even after we've restarted reserve management purchases. So my perspective is not only are the RMPs not QE, but that the tightening effects of QT are still happening even though we ended balance sheet runoff.
Two follow-ups on that. You covered a lot of ground there. The first is the Fed formalized in June of 2021 a standing repo facility. I say formalized because starting in September of 2019, the Fed had been doing substantial repo operations as well, and then obviously a lot of those in the spring of 2020. Any comments on how effective the standing repo facility is, where it fits into the toolkit in terms of the Fed's operating framework?
Well, I have to say it's disappointingly not as effective as we would like it to be. In the last day of November, the first day of December, I think we had well over $1 trillion of money of repo change hands, 10 basis points above IORB, right? So, or actually more than that. I have to say the standing repo facility has not performed, as I think we would have hoped it would have. It's a ceiling tool that hasn't really functioned as a ceiling tool. Yeah. And then there's a variety of diagnoses about why that's the case and what steps would you want to take, if any, to fix it. And I think that's sort of an ongoing conversation among the FOMC.
An understandable answer. And then one more follow-up. I'm glad that you did mention that you're continuing to allow the MBS portfolio to run off at various times over the years, including, I think, in the minutes of meetings in 2022, and then going way back a decade before. The committee at various occasions before you arrived discussed actually selling mortgages as opposed to passive runoff. And so any comments on that as opposed to the current policy, which is just letting the MBS portfolio run off passively? Because a lot of mortgages, I think the last time I looked, around $2 trillion of mortgages held by the Fed.
Yeah, let me just correct what I said a moment ago. It wasn't repo that traded that high. It was SOFR. But on the, I always get lost in the alphabet soup of these short-term instruments and.
You've got company.
Yeah.
Yes. Okay.
So with respect to MBS, yes, the Federal Reserve does own a lot of MBS. Yes, I would prefer in all Treasury balance sheet, unless there is, for some reason, a credit crisis that brings you to a financial crisis that brings you to the brink of a Great Depression that is centered in the housing market in the way that it was in 2007, 2008. There is a time when the Federal Reserve should be holding these things. It's just when there's a genuine emergency, and there's not an emergency centered in the housing market, and there hasn't been for, almost 2 decades now. I would also prefer not to own any of these things on our balance sheet. The most straightforward way, as you're saying, is to just sell them and replace them with something else. I do not support that type of activity, and the reason I do not support that type of activity is because many of these securities are now trading below in price where the Federal Reserve bought them. And if the Federal Reserve sold them and replaced them with other securities, we would be crystallizing those losses on the Federal Reserve's balance sheet and realizing them for taxpayers. Yes, there are questions about, does that really matter? The Fed can operate with an infinitely negative capital position. That's true from a monetary policy perspective. If faith in the Federal Reserve remains unaffected, but I think that realizing those losses and depriving ourselves of the pull to par that would bring us towards regaining those losses would potentially lead to some adverse questions about the Fed, and it would also affect the profitability of the Fed and the remittances that we send to the fiscal authority. So, I think there's a variety of negative consequences from selling those assets. And so, while I would prefer in all Treasury balance sheet not to own any of these mortgages at all, I'm not willing to realize the losses that you would have to realize to get there by faster action than roll down.
I'm going to move on to R-Star because you've made a lot of news in your time as a Fed official. But before I do, maybe just a segue. I think a lot that can be gleaned when you're looking at central banks by looking across countries, especially in response to a common shock like COVID, And I've done that, and others have done that. And what's interesting, Governor, is some other central banks, first and foremost, the Bank of England, but I think also in Sweden as well, have actually made the decision to sell securities out of their portfolio to run down the balance sheet. So there's not a one-size-fits-all practice on that. But on R-star, first of all, what is R-star? Another of those technical terms. It's simply the real interest rate adjusted for inflation that should prevail when the economy is where you want it to be, at full employment and on the inflation target. And you stated before that you believe that R-star is lower than do many of your colleagues. So can you elaborate on that?
Sure. So I spoke a lot about this subject in the first speech that I made as a member of the Fed board shortly after we cut rates for the first time this year. I think there's a variety of things that have driven neutral rates down. We talked about population growth before. That's, I think, very intuitive, and I think that it's one that is, that is relatively uncontroversial. It was less than 10 years ago that we were all sitting around discussing whether everyone was going to become Japan, and whether Japan was the future of the entire developed world. And part of that was due to lower population growth rates that were sort of trending lower and maybe not quite Japanese level, but trending much lower over time, and everyone heading in that direction. And of course, that helped explain the decline in interest rate, the secular decline in interest rates that we'd seen for the 4 decades going into the pandemic. I don't think that logic ever left us. I think that logic has always been with us. It has just been masked by a variety of other things. On population growth, we had this surge in immigration in the United States, and the reversal. We experienced population growth went up by, I don't know the number off the top of my head, but it went up by a lot, and it was the biggest population growth shock that we've seen in 40 years or something like that, right? We experienced 30 years worth of changes to the population growth rate in a 3-year period. And that has an effect on the structure of the economy. Other things too that I think have, and that's now reversed, right? Population growth soared up and now it's come crashing down in a very short period of time. I think also the changes in fiscal revenue drive neutral rates lower. Neutral rates are determined by the supply-demand balance for loanable funds in the economy. And if you have less borrowing because there's more fiscal revenue, then as a result, the neutral rate should come down. And as you can tell from what I spoke about before, my view is the vast majority of the incidence of tariffs are borne by the exporter and not the importer when you're the United States. For different countries, it might be different. But from the United States perspective, most of the incidence of tariffs is, in my view, borne by exporters, which means that the revenue that we get basically just reduces national savings. It's new revenue, it's a new tax, right? And as a result, the lower national borrowing drives interest rates down. Better economic growth from policies like cutting regulations delivers more revenue, delivers lower deficits as well. And as the amount of national borrowing declines in the economy relative to the amount of national saving, that will push the neutral interest rate down.
Average and median real wages are higher today than in 2019, and yet many Americans feel worse off. Did Fed monetary policy contribute to the concerns about affordability that many Americans have expressed recently?
I think that there's no question that there's a relationship. I think that the housing market is central not only to my view of inflation, but I think that it's the top budget line for a vast majority of households, right? Is how much are they spending every month on their rent or their mortgage? Can they afford to live? Can they get the home they need to raise a family in? Are they stuck in place? Can they push forward and move forward with the American dream? And, look, the Fed owns a lot of mortgages, as you described a moment ago. And us owning a lot of mortgages injected a lot of credit into the housing market. So I think there's no question there's a relationship between choices the Federal Reserve has made and some of the affordability issues that are facing Americans. Is the Fed the source of too high inflation right now? Absolutely not. I don't think that's the case at all. And as I said before, I think that underlying inflation is actually running just about at our, it's within noise of our target. It's just a hair above our target. And so I don't really think in terms of underlying inflation there is any excess relative to our target. But I think that for sure there are steps that the Federal Reserve took in the past to inject credit into the housing market that have resulted in some of these changes. And it's not to say that the Fed is responsible for all of it. That's absolutely not what I'm saying at all.
Of course.
I also think immigration played a role in the housing market too. I think if you throw millions of new inhabitants into a relatively fixed supply of housing, you're going to push the price of housing up. And that's just supply and demand, and of course there's an abundant microeconomics literature on that effect too.
We are at a School of International and Public Affairs, and many of our students are international. So I do want to ask maybe one or two related questions on the Fed and the global economy. And this is certainly a question that I got many times as Fed Vice Chair, but I'll ask it to you as well. So how does the Fed take into account potential spillovers of U.S. monetary policy to the rest of the world? Does it take it into account at all, and how do you think about it?
Yeah, so look, the Congress told us to focus on stable prices and maximum employment. And so what's happening in the rest of the world matters if it affects stable prices and maximum employment in the United States. And we do not target foreign economic growth. But what's happening in foreign economies can absolutely spill over to affect stable prices and maximum employment in the United States. And to the extent that what's happening internationally affects the US economy and therefore affects whether the Federal Reserve is meeting its targets that are given to us statutorily by the Congress, that's absolutely something that I would think about.
A related question in terms of what you look at on your screens every day at the office in financial markets, domestic variables, international variables, commodity prices. I guess the Greenspan answer would be you look at everything, but I'll let you answer it. As someone who came from financial markets.
Yeah, as someone who came from financial markets, I'm looking at my screens a lot less than I used to.
Okay.
I used to be glued to them all every second of every day, and now I'm lucky if I get to spend like if I get to see the screen a few times a day in terms of where the market's at, where the price is at. But look, I'm focused on a couple things. So I'm focused first and foremost on the economic data because that's what matters for achieving the targets that are set to us by the Congress. But there are also signals that you can get from financial markets. Financial markets contain information sometimes that are useful for us in helping to adjust our forecast. And you saw before I referenced CPI swaps, right? I think that inflation swaps are a very, very valuable piece of information about what's developing in the economy. And they've actually, it's actually been interesting to me. 1-year CPI swaps have actually come in quite a lot since we I haven't looked at them in a few days, so I could be a few days out of date since late last week. But they've come in a lot since we started cutting rates in September, to the extent that the 1-year forward-looking real rate, if you just take a 12-month bill rate and deflate it by the 1-year CPI swap, it's actually gone up by like 0.75 of a percentage point since we started cutting rates, which makes me question whether we've actually, how much of an effect have our cuts have if real interest rates are actually moving up while we cut. So I look at CPI swaps a fair amount. I look at fixed income markets in general a fair amount. Commodities are very helpful. Equities I think are affected by a wide variety of things that are sometimes very tightly related to monetary policy, but sometimes not. And if you have a huge surge in productivity growth that's driven by something like AI, which may happen, which may not happen, but that's going to be present in equities to a much greater extent than it is in fixed income markets. And so, so I'm trying to, like former Chairman Greenspan, trying to look at as much as I can. But most of the signals I'm looking for on inflation and the labor market are concentrated in some parts of asset markets.
Now, I'll ask you about one particular Bloomberg screen, which I consult a lot, which is WIRP, World Interest Rate Probability. And so, do you confess to looking at that?
I do. I mean, look, I used to compute those probabilities by hand based on counting the number of trading days in a month, and the number of
Just for the audience, it's the Bloomberg screen which gives the real-time market probability of a Fed cut at each meeting for the next year. So, for example, going into the meeting last week, I think the WIRP probability was 98% or 96%. So I'm just explaining to the audience what that's going.
So I no longer have to compute it by hand based on based on the number of trading days in a month and figuring that all out. And so that's actually been a huge productivity growth that has enabled me to be more productive. However, that has not shown its way into the national data yet.
Not yet. One thing I would be remiss if I didn't ask you. The Fed made some other news last week after the meeting, in that it was reported that there was a vote of the board, which I believe was unanimous, to reappoint the 11 Reserve Bank presidents who aren't retiring. And since it was unanimous, you voted for that as well. So any comments on both that vote, the reserve banks in the Federal Reserve process?
No, so one of the advantages of the Federal Reserve is that it's a national system of the board, which is located in Washington, and the reserve banks, which are spread out across the country. And one thing that the reserve banks do is they give you a local window into what's happening in regional economies. And that is so valuable because economic data are important. But as I tried to labor in my speech, sometimes the data don't mean what you think they mean. And the fact that these reserve banks have such broad networks of contacts in their local economies and can tell us what's happening in those economies on the ground level and filter that information up to us is so valuable and is one of the real core advantages of the organization of the Federal Reserve as it has been organized. And so I was delighted to have the opportunity to vote like that. And I think the reserve banks and their presidents are doing a great job.
Okay, one last question. We are drawing out of time. You've been a governor during a very eventful period, even though it's been brief. What has been your biggest surprise? When I joined the Fed, I'd been a Fed watcher for decades, but I got surprised every day. So what's been your biggest surprise? What have you enjoyed most about the job? And then to put you on the spot, what have you enjoyed least about the job?
Oh, man. So let's take it backwards because that's easy. So what have I enjoyed least is just being one member of a committee of 12 that doesn't get to make decisions. So I get a vote, as you got a vote also, right?
Yeah.
But as is obviously clear, I'm far from the pivotal decision maker. What have I enjoyed most is I've been interested in these questions for decades, right? And it's such an honor and a privilege to be able to discuss them with a bunch of other people, very intelligent people who are very interested in these subjects also, and to be able to have interesting conversations with interesting people about things that I care about. That's just such an honor and a privilege. And what's been most surprising, I would say, how nice and collegial everyone has been. It's been a very collaborative, collegial environment, and that has been of enormous value to me.
Well, we could go on and on, but we're very much, Governor Miran, respectful of your time. Thank you for your service. And please, in the audience, join me in a round of applause for Federal Reserve Governor Stephen Miran. Thank you.
Thank you for having me.